Welcome! In this video, Zbcn coin broke the staking record. What will happen? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. The ascending triangle formation is considered a powerful and reliable bullish signal in technical analysis. This pattern indicates that while price action forms higher lows over time, it repeatedly touches a horizontal resistance level. In other words, buyers are entering the market at increasingly higher levels, while sellers are defending a specific resistance zone. This setup suggests that upward pressure is building, and eventually that pressure could lead to a breakout to the upside. Especially toward the end of the formation, a drop in volume followed by a breakout supported by high volume may indicate that the pattern is holding strong and that buyers are preparing to take full control. Looking at the current scenario, the price continues to move within the interior of the ascending triangle and is positioned quite close to the upper resistance line. At this point, the patience and strength of the buyers are crucial. Each time the price reaches this resistance line, it may have tested but failed to break through previously. However, every test indicates a weakening of the seller's strength and a disruption of the market balance. The next test of this resistance zone, accompanied by increased volume, will be a key factor in determining how strong and lasting the breakout will be. If the price breaks above this horizontal resistance with strong volume, a price increase equal to the base height of the triangle can be expected. This is the classic target of the ascending triangle formation. In ascending triangles, breakouts are typically to the upside, as buyers continue to enter the market at higher price levels, reflecting their confidence and demand. This sustained pressure often leads to the eventual breach of the resistance level. The lower boundary of the formation acts as the support line of the rising trend. This support line is a critical indicator of market confidence, as it shows where buyers consistently step in during pullbacks. If the price continues to bounce upward from this support line, the structure of the formation remains intact, and the likelihood of an upward breakout increases. In the current chart, the price has recently bounced from the lower support line, reinforcing the validity of the pattern and suggesting that a bullish breakout may be imminent. The behavior of the price at the moment of the breakout is also highly significant. If the breakout occurs without volume, it may be a false breakout, and the price could return within the triangle. However, an upward breakout accompanied by strong volume is usually more permanent and presents serious profit opportunities for investors. In such cases, a move equal to the triangle's base height is expected. In this setup, the triangle's height is substantial, and the potential price increase could also be large as a result. This rise is estimated to exceed 1,000%, offering a significant gain for early investors. In some cases, depending on market conditions, the increase could be as high as 3,000% or even 5,000%. The ascending triangle typically forms during consolidation phases and often results in buyers gaining the upper hand over sellers. Therefore, price action continuing within the triangle's boundaries is a very positive sign for patient investors. Furthermore, such formations usually align with the prevailing trend direction, meaning that if the primary trend is upward, a breakout from the ascending triangle also signals a continuation of that trend. Thus, in addition to the structure of the formation, the general market trend should also be taken into account during analysis. Ascending triangles that form within a broader uptrend often indicate growing strength in the market and the potential for new price highs. The upper resistance line of the ascending triangle is typically seen as a zone where many investors take profits. As a result, when the price approaches this area, short-term selling pressure may emerge. However, since each round of selling is met with higher buying levels, buying pressure continuously builds. This dynamic weakens the resistance line and ultimately leads to a breakout. In the current situation, the price is once again approaching this resistance, setting the stage for a new breakout attempt. If the price successfully breaks through, investors may begin to increase their positions, which could lead to a rapid surge in price. These kinds of movements, especially when supported by volume, often trigger FOMO among market participants, drawing in new buyers and accelerating the price even further. The price target following an ascending triangle breakout is calculated based on the height of the triangle. For example, if the triangle's height is 100 units and the breakout occurs at 500 units, the target price would be 600 units. This target can sometimes be exceeded, as breakouts often coincide with a shift in investor psychology. If a resistance level has held for a long time and is finally breached, it also signals a psychological barrier being broken. This shift leads to more aggressive buying behavior from investors. Currently, the price is at the edge of a potential breakout, creating excitement among market participants and potentially opening the door to a massive rally. Reaching the target price after the breakout doesn't always happen in a straight line. Often, the price will pull back after the breakout in a move known as a retest, where it tests the former resistance level for support. If this test is successful, meaning the price bounces from the old resistance, this confirms the breakout and increases the likelihood of continued upward movement. During this retest, it's important for investors to be vigilant, as re-entering at this point can minimize risk while still participating in the upward move. This strategy is widely used and considered reliable in technical analysis. In the current scenario, if the price retests the breakout level and holds, reaching the target price becomes much more likely. An ascending triangle breakout isn't just an opportunity for short-term trades. It can also be a major opportunity for long-term investors. These patterns can appear on weekly or even monthly charts, and in such cases, the breakout's impact is even more significant. Long-term investors may enter positions early, anticipating that the price could multiply after the breakout, leading to major profits. But we can't base our entire analysis on this alone. So let's take a look at other metrics as well. Stay tuned. The fact that the price is positioned above the 200 EMA is a strong indicator of a long-term upward trend in technical analysis. This suggests that investors in the market generally maintain an optimistic outlook and continue to expect prices to rise further. The 200 EMA is a widely followed indicator, especially on higher timeframes, and as long as the price stays above this level, the probability of an ongoing uptrend increases. Remaining above this technical level also implies that the price is maintaining positive long-term momentum and that large funds or institutional investors are still holding long positions in the market. Many technical analysts view the 200 EMA as a kind of lifeline. When the price trades below this line, it's typically assumed to be in a downtrend. When it's above, it's seen as being in an uptrend. In this context, the price continuing to hold above the 200 EMA not only shows that the current uptrend is not a coincidence, but that it is a technically supported, strong, and sustainable trend. This builds investor confidence and increases buying appetite. As a result, market participants, especially those considering long-term positions, often view this level as a solid support zone, and any pullbacks toward this area are seen as new buying opportunities. Particularly in the crypto market or in highly volatile stocks, staying above the 200 EMA provides not only technical but also psychological support. This level is a widely respected indicator that has been tested numerous times in the past. When an asset that has been trading below the 200 EMA for a long time breaks above it, this is often interpreted as a trend reversal and seen as a strong bullish signal. Conversely, as long as the price continues to hold above this level, the technical analysis motto, "The trend is your friend," remains valid. This means that as long as the price is above the 200 EMA, taking long positions remains a technically sound strategy. Staying above the 200 EMA becomes even more significant when viewed on weekly or monthly charts. Signals generated on these time frames are fewer but much stronger. Remaining above this level for an extended period indicates not only sustained trend strength, but also a safer entry point for new investors. At the same time, these levels tend to attract the attention of large investment funds, as such funds typically seek low-risk, high-probability opportunities. A price trend that remains above the 200 EMA generally meets these criteria.
As the price stays above this level, it tends to form higher lows and higher highs. In technical analysis, this pattern represents a classic bull market structure. Each correction ends without falling below the previous low, and the subsequent rise surpasses the previous high. This indicates that the trend is healthy and sustainable. Price action that remains above the 200 EMA supports this structure and helps push the price even higher after each correction. This strengthens investor confidence and keeps market interest alive. The 200 EMA is also a core component of many algorithmic trading systems. These systems often base buy or sell decisions on whether the price is above or below the 200 EMA. Therefore, staying above this level is not only a positive signal for retail investors, but also for institutional algorithmic strategies. This contributes to increased trading volume, improved liquidity, and indirectly supports a more stable price increase. Higher liquidity in the market, in turn,
This small cup formation observed on the chart is considered a highly positive pattern in technical analysis. Small cups typically indicate that after a certain period of price decline, the market begins to recover, offering strong visual signals that this recovery may continue. These types of formations usually emerge after a correction or consolidation phase and provide investors with insights into the market's direction. Especially in this example, a clearly formed small cup structure serves as a strong indicator of an upcoming bullish move. Cups encompass many favorable elements, both psychologically and technically. The beginning of the cup represents a period where investors are still uncertain and selling pressure is high. During this phase, prices tend to decline and continue to do so until reaching a certain level. Then, prices move sideways in a bottoming phase, often referred to as the accumulation stage. At this point, the selling pressure fades, giving way to increased buyer interest. During this process, the price gradually recovers, forming the other half of the cup. This second half typically shows a more stable upward trend, often supported by increasing volume. As the price approaches the initial level, known as the neckline, a breakout above this level, if accompanied by strong volume, generally leads to a price target equal to the depth of the cup. This is one of the fundamental bullish projections in technical analysis. The fact that the cup formation in this analysis is small shows that it may also present opportunities for short-term investors. Small cups tend to form more quickly than larger ones and can reach their price targets in a shorter time frame. This is particularly advantageous for short-term traders, as these formations offer quick reaction potential and rapid upside movement. Targeting a price equal to the depth of the cup is a systematic approach, as the movement during the formation often reflects a symmetrical price action that serves as the basis for the projection. The bullish target being equal to the depth of the cup is directly related to market psychology. Two key psychological shifts occur during the formation process. First, the fear and panic experienced during the initial decline gradually transform into calmness and then confidence. Second, as buyers return to the market, the price begins to climb back toward previous levels. This renewed sense of confidence leads to more decisive buying behavior, helping the price not only return to its previous high, but also push higher by the same depth as the cup. This technical target often fuels additional buying momentum, triggering a chain reaction of upward movement. Additionally, a surge in volume at the breakout point of this cup pattern significantly reinforces the validity of the formation. A breakout with high trading volume indicates that investors are taking the move seriously and confirms the market's general direction. Without strong volume, breakouts often fail. However, if the cup pattern in this example is clearly defined and the breakout is supported by high volume, it provides investors with a strong and reassuring technical signal. Such patterns allow investors to act with greater confidence and apply their strategies more decisively. The small size of this cup formation also offers more frequent trading opportunities for investors. While large cups typically take weeks or months to develop, small cups can be clearly seen on daily or even hourly charts. This presents short-term traders with more frequent entry and exit opportunities. Furthermore, small cup formations often appear at the end of downtrends and may serve as early signals of a trend reversal. Thus, this structure not only suggests a potential upward target, but may also indicate a shift from bearish to bullish market sentiment, making it a highly valuable tool in technical analysis.
The potential gain from the cup's target, expressed as a percentage, makes this pattern even more attractive. For example, the depth of the cup may represent a gain of 30%, 50%, or even 100% or more. These types of profit potentials are especially common in cryptocurrency markets, which are known for their high volatility and sensitivity to technical formations. In this context, small cup patterns play a major role not only in traditional markets, but also in crypto markets. Investors can use these structures to make more informed buying decisions and position themselves more securely in the market. In conclusion, this small cup formation presents a highly positive signal for investors. Its technical structure, the method of setting targets after breakout, and its evaluation in conjunction with supporting indicators all contribute to more accurate investment decisions. Although small cups may appear short-term in nature, when analyzed correctly, they can mark the beginning of significant price movements. A clearly visible cup formation like this one indicates that the price may be preparing for an upward move. And this move, following the projection of the cup's depth, can offer serious profit potential to investors. Therefore, small cup formations are extremely valuable patterns for both professional traders and those who base their strategies on technical analysis. This structure on the chart suggests that the market is gathering strength and preparing to make an upward move. If the price acts in accordance with this formation and reaches the projected target, it is highly likely that investors will benefit from this movement. Thus, this technical structure should not be overlooked and must be monitored carefully.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.